Money. It's something we use every day. Money is anything widely accepted as payment for goods and services. It might be seashells, beads, or digital tokens. Money serves three primary functions: medium of exchange, unit of account, and store of value. As a medium of exchange, it simplifies trade. As a unit of account, it measures value. As a store of value, it allows saving for future use. Without money, our modern economy would grind to a halt. It's an essential tool for trade, value measurement, and saving. In the beginning there was barter. This was the direct exchange of goods and services where people traded what they had for what they needed. This system worked well for small communities where everyone knew each other and the needs were simple. But as societies grew larger and more complex, barter became impractical due to the difficulty in finding matching needs. Commodity money like gold and silver entered the scene. These metals were universally valued and could be used in trade. These had intrinsic value and were durable, divisible, and scarce, making them ideal for use as money. However, commodity money was heavy and fluctuated in value, making it cumbersome for everyday transactions. Enter fiat money, which is not backed by a physical commodity like gold or silver. Its value comes from government declaration as legal tender, meaning it must be accepted for payment within the country. The paper money we use today is fiat money, which is convenient and easy to carry. Fiat money is flexible. The government can adjust the money supply to meet economic needs. However, it is susceptible to inflation if overprinted, which can devalue the currency and reduce purchasing power. This evolution shows how money has adapted over time to meet the changing needs of economies and societies. How do economists measure the amount of money in an economy? This is where the money supply comes in. The money supply is the total amount of money in circulation at a given time. M1 includes the most liquid forms of money currency, demand deposits, and travelers' checks. M2 includes everything in M1 plus savings deposits, small-time deposits, and money market mutual funds. Tracking the money supply helps understand economic health. Rapid increases can lead to inflation. Contractions can stifle growth. Central banks, like the Federal Reserve, manage the money supply. The Fed, America's money manager. The Federal Reserve System, or the Fed, manages the U.S. money supply. Established in 1913, it balances centralized authority and regional representation. The Fed consists of 12 regional banks overseen by a board of governors. The Federal Open Market Committee, FOMC, makes key monetary policy decisions. Their goal is to promote stable prices and maximum employment. The Fed's decisions impact everything from mortgage rates to business loans. Banking on it, how banks create money. Banks act as intermediaries between savers and borrowers and can create money. They do this by taking deposits from customers and then lending a portion of those deposits to others. This process, known as fractional reserve banking, expands the money supply. Essentially, banks are required to keep only a fraction of their deposits in reserve, allowing them to lend out the rest. When you deposit money, the bank keeps a fraction in reserve and lends out the rest. This means that your deposit can be used to fund loans for other customers. For example, with a 10% reserve requirement, a $1,000 deposit allows the bank to lend $900. The remaining $100 is kept in reserve to meet withdrawal demands. This borrower deposits the $900 and the cycle continues. The bank can then lend out a portion of this new deposit, further increasing the money supply. This lending and depositing cycle creates new money. Each time a loan is made and deposited, the total amount of money in the economy increases. The initial deposit leads to multiple times that amount in new money. This is because each round of lending and depositing adds to the total money supply. This is the essence of fractional reserve banking. It allows banks to create money through the process of taking deposits and making loans, thereby fueling economic growth. The money multiplier and the Fed's balancing act. Fractional reserve banking gives rise to the money multiplier. This system allows banks to hold only a fraction of their deposits in reserve, lending out the rest to generate more money in the economy. The multiplier represents the amount of money the banking system can generate with each dollar of reserves. Essentially, it shows how initial deposits can lead to a greater total money supply. The size of the multiplier depends on the reserve requirement set by the Fed. This requirement dictates the minimum amount of reserves a bank must hold against deposits. A lower reserve requirement leads to a larger multiplier. This means banks can lend more, increasing the money supply and potentially stimulating economic activity. The Fed must manage this balance carefully. If the reserve requirement is too low, it could lead to excessive money creation and inflation. Rapid money supply growth can lead to inflation. Sharp contractions can stifle growth. Inflation erodes purchasing power, while a lack of money can slow down economic progress. The Fed uses tools like open market operations, reserve requirements, and interest rates to influence the money supply. Open market operations involve buying and selling government securities to regulate the amount of money in the banking system. Controlling the money supply is complex, influenced by many factors. These include economic conditions, market expectations, and global financial trends. Understanding the Fed's role helps appreciate its impact on our economy. By managing the money supply, the Fed aims to promote stable prices and maximum employment, ensuring a healthy economic environment.